All right, let's jump right in. Welcome to today's Explainer, where we're unpacking a massive structural anomaly in the global digital asset market as of August 22nd, 2026. If you've been watching the charts this week, you already know traditional asset correlations haven't just bent, they've completely broken down. We're looking at a market where the old textbook rules simply aren't applying anymore. So today, we're putting on our strict analytical hats to break down a Tier 1 institutional strategy report that explains exactly why this is happening. To really understand what's going on, we have to start right here. $40 trillion. The U.S. national debt surpassing this number is now the single macroeconomic reality that is overriding all traditional pricing models. Clinically speaking, it's the massive gravity well that literally every other financial decision is currently orbiting. Here's our top-down matrix for today. We're going to cover the macro liquidity, structural inflection, regulatory alpha, on-chain dynamics, and the short squeeze, institutional cross-verification logic, and finally, strict action scenarios. Starting off with Section 1, macro liquidity structural inflection, let's look at the overarching macro catalysts driving this environment. Notice the absolute paradox we're facing right now. On the left, we've got 30-year U.S. Treasury yields spiking back up to 5.25%. We haven't sustained these levels in roughly 19 years. Traditionally, soaring risk-free yields absolutely crush non-yielding assets. But then look on the right. We have a violent, parabolic Bitcoin rally surging past $78,400. This totally broken correlation between peaking yields and the surge in a scarcity asset is the defining anomaly of the week. And this really gets to the root cause of that anomaly, QE Lite. You see, the U.S. Treasury was basically forced to intervene in a highly illiquid bond market, doubling their long-term bond buybacks from $2 billion to at least $4 billion per operation. Now, while it's not technically full quantitative easing, the market is reading this direct liquidity injection exactly the same way. It's effectively the Treasury stepping in to suppress yields, which signals to the market that dollar debasement is an administrative inevitability. So the crucial takeaway here is this narrative pivot. We've entered this psychological bad is good phase. Think about it. Recently, we've seen major geopolitical tensions in the Middle East, rising oil prices, and skyrocketing debt. Normally, that is heavy bearish friction. But institutional capital has entirely flipped its perspective. They're treating these geopolitical tension and massive debt as urgent reasons to accumulate debasement hedges. Bad news is now a bullish catalyst. Which brings us to Section 2, regulatory alpha and narrative pivot. Let's see how legislative frontrunning is acting as rocket fuel for these prices. We need to map out this exact timeline because the cascade from August 19th to the 20th is what triggered this structural breakout. On August 19th, the Treasury announces the QE Lite buybacks. That exact same day, President Trump hosts a high-profile meeting with crypto executives at the White House. And the institutional response? It was immediate. Binance records a staggering $4 billion taker-buy volume, meaning aggressive at-market purchases in a single hour. By the very next day, a $1.25 billion short squeeze is flawlessly executed. That White House meeting, which everyone's been calling the Crypto Avengers meeting, centered heavily on this, the Clarity Act. President Trump applied direct pressure on lawmakers to finally pass this long-stalled market structure bill, and there's a looming deadline of September 15th. Adding fuel to that fire, the CFTC immediately pledged to move swiftly on execution if the act passes. The market isn't waiting around for the ink to dry, guys. It is actively pricing in this regulatory de-risking right now. And right in tandem with that legislative push, we saw the SEC propose a massive new framework, Regulation Crypto Assets. Look at these exemptions. We're talking a $5 million startup runway, a $75 million fundraising tier modeled on Reg A, and critically, federal preemption of state laws for covered investment contracts. This right here is what we call regulatory alpha. Institutions are aggressively accumulating because the roadblocks are visibly being dismantled. Let's move to Section 3, on-chain dynamics and short squeeze. We've got the macro liquidity and the regulatory alpha. Now let's drill into the on-chain microstructure that weaponized it all. While retail investors probably thought the market was just moving sideways for the last few months, a massive supply cluster was secretly forming on-chain. 3.44 million Bitcoin, which is roughly 11% of the entire circulating supply, changed hands and was heavily accumulated between $58,000 and $67,000. That created an unbreakable liquidity floor. So when that 4 billion Binance taker buy candle hit, it launched directly off this unyielding base, easily shattering that $68,700 resistance. And here is the direct aftermath of that unbreakable floor. For the longest time, long liquidations dominated the market. But notice this historical flipping for August. Short liquidations hit $7.74 billion, officially overtaking long liquidations at $7.58 billion. This proves that the bearish liquidity in the system has been completely exhausted. The bears literally ran out of ammunition. And the violence of this squeeze, it really cannot be overstated. $700 million. That's the exact amount in short positions that were vaporized in a single minute. When that resistance broke, it triggered a forced buying feedback loop. Short sellers were automatically forced to buy back in at market prices to cover their positions, driving the price even higher and liquidating even more shorts. All right, Section 4, Institutional Cross-Verification Logic. How do we know this is a structural shift and not just a flash in the pan? We have to filter out the retail noise from the true institutional signal. If you just look at traditional exchange data, you might actually get tricked. Retail spot trading volume has plummeted to the 10th percentile, levels we literally haven't seen since the 2019 bear market. Bearish analysts point to this and say, hey, there's no demand. But that's a total data illusion. Demand hasn't disappeared. It's completely migrated to institutional plumbing, with ETF inflows pulling in $1.6 billion a week. The capital is flowing efficiently, it's just not happening on retail spot exchanges anymore. Let's look at a prime case study of how smart money is operating right now, 66 Capital. They completely pivoted their treasury strategy. They didn't just sit on their hands, they actively restructured. First, they liquidated their ETF holdings and repaid their debt. Then, they moved to acquire direct on-chain Bitcoin for absolute custodial control. And finally, they purchased high strike call options for 200 Bitcoin at a $100,000 strike price extending out a full year. This is smart money extending their long upside duration, betting heavily on continued structural growth. Okay, let's wrap this up with Section 5, Final Verdict and Action Scenarios. What do we actually do with this data? Here are the strict binary strategic scenarios for capital allocators. Scenario A is our bullish continuation. If we're really heading toward $100,000, here's what must happen. We need to see ETF inflow momentum sustain at over $500 million daily. Crucially, that 30-year Treasury yield must remain capped by the government's QE Lite buybacks. If those conditions hold, the recommended institutional action is to overweight direct spot holdings, but definitely hold off on adding heavy leverage until we see funding rates normalized a bit more. But as analytical thinkers, we always prepare for Scenario B, the bearish reversal. The immediate threat right now is that perpetual futures open interest has ballooned to $57.7 billion. The market is getting top-heavy. And the true black swan here? A third delay of the September 15th Clarity Act. The market has basically priced in regulatory perfection. If Congress fails to deliver, we hit a threshold of a potential 20% downside risk, what analysts are calling one final flush. If bond yields start breaking aggressively upward again, implement tight hedges immediately. And if you want a single vulnerability metric to watch tomorrow, it's this, 0.013%. That is the current perpetual futures funding rate. That number signals that the market is heavily skewed with over-leveraged longs who are paying a premium just to stay in their positions. The fuel for the short squeeze is gone, meaning the pendulum of risk is currently swinging back toward long liquidations if momentum stalls out. Which leaves us with this final, absolutely vital question to consider today. Is your portfolio hedged against a potential Clarity Act delay on September 15th? The macro setup is incredibly bullish, yes, but the leverage in the system demands respect. Don't let the regulatory euphoria blind you to the tail risks. Take a hard look at your exposure, rebalance according to the data, and we'll see you on the next explainer.